It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. It is Managing Your Financial Future, something that is done every day here, pretty much, with the folks at Lucia Capital Group. We like to talk about strategies on this here podcast. We talk about financial issues, and as I say, we do try to come up with some potential solutions to the many financial challenges that people have in life. Finance can be difficult. It can be complicated. It is. And we try our best to make it somewhat less complicated. And we do talk about strategy. In fact, we're going to be talking about that today on this particular podcast. I'm Johnny Dean. I am moderator. That's right, moderator. It sounds like one of those, it sounds like one of those monsters from the old monster movies, moderator. That's me. I'm not an advisor. I don't even play one on television, but I do hang out with this guy, Professor Plum. What, certified financial planner professional? Is that what we call you, Professor Plum?
You can call me whatever you want, as long as you don't call me late for dinner.
All right, I won't do that. You're the brains of this outfit, but I said this many times that just by hanging out by osmosis, I happen to learn a lot. And so my advice to people, as I have said again before, is that if you really want to learn a lot about finance, you can either go to Professor Plum's house, hang out for a year or so, maybe. Year and a half?
Actually, come to the office because I really don't talk a lot of finance at the house.
Well, that's true. All right. So if you don't talk finance at the house, you're going to talk about it at the office. Hang out with him for as long as you can, or just listen to this podcast, which I think is a little bit more, I think that's a little bit more convenient for most people. And speaking of listening, we do get people asking us questions from time to time. And I want to get into this a little bit because last week we talked about Roth conversions. We got into that a little bit and some of the strategies of Roth conversions. And so we had a question about the topic of Roth conversions. And it went something like this, Professor Plum, as I paraphrase here. Is it better to do, if you're going to do a Roth conversion, is it better to do one at the end of the year or at the beginning of the year? Now, we are slowly approaching the end of 2020. Finally!
Oh, God. But pretty soon we'll be at the beginning of 2021.
Yes. Now, okay, first of all, explain why somebody may want to be concerned about whether they should do it at the beginning of the year or the end of the year. Let's just talk in generic terms about that, first of all, if they're going to do a Roth conversion, Professor.
Well, I was actually having this discussion the other day with some people I know and their accountant, and they wanted to know, the part of their planning process was to do conversions while they have almost no income for the next couple of years until their pension kicks in at age 60. And we're talking about doing Roth conversions, not letting a low tax bracket go to waste because they will be in a high tax bracket later on. And so the question came up, should we do the conversions at the beginning of the year or should we do the conversions at the end of the year? And it somewhat depends on how your income is structured, what money you're living off of. For some people, the majority of their money is their IRAs. And so they're taking X amount of dollars out of their IRAs to live, but they still consider they have more room to convert, so they want to convert. If that's the situation, I'd rather do the conversion at the end of the year, so that if there's an emergency through the year and you need more money, you can take it out of the IRA and use up the tax bracket and not do the Roth conversion. If you did the Roth conversion at the beginning, you've already used up the bracket. Then if you have that emergency, and you have to draw more money from the IRA to live, now you've jumped up another bracket. That's not a good idea. And we used to have a lot more flexibility because we used to be able to undo conversions. So if we did a conversion at the beginning of the year, we had until basically October 15th of the following year to undo it.
That ended.
We don't have that option anymore.
When did that end? A year or two ago? It wasn't that long ago.
3 or 4 maybe now.
Okay.
But if you do a conversion of a traditional IRA to a Roth IRA, it is a one and done, you cannot undo it type of thing. Contributions to an IRA or Roth IRA can be reclassified, can be undone, but conversions cannot be recharacterized back to the original. So we've got to be more careful with that. So if you're in the situation where you're using your IRA already and your emergency, if you have needs for extra funds and the only place to get them would be your IRA, I would say that doing a conversion at the end of the year is going to make more sense just in case you have that emergency and you need to draw more money out of the IRA to live. Now, the individuals that I was speaking with earlier, or yesterday actually, they have a large cash position outside of their IRA. They're actually living on cash in the bank for the next couple of years for some planning reasons we may or may not get into. So they control their income. And if they have an emergency, they have plenty of cash outside of their IRA to cover the emergency. So now it becomes not a tax thing. We know we're going to convert X amount of dollars. We know what the taxable event's going to be. Should we do it at the beginning, middle, end of the year? And my personal choice, and this is just an opinion, is that we do it early in the year, get it over with, get it done with. And we go with the assumption that the markets are up more often than they're not. The reason I say that is because a lot of people say, well, I want to convert. I don't want to convert at the beginning of the year because what if the markets go down and I could have converted more for the same amount of tax dollars later in the year? I say, okay, that's true, but what if they go up, the markets? And you can't convert as much of your IRA percentage-wise because it would cost you much in taxes. And the odds seem to favor the markets being up more often than not. And unless you're just truly Murphy's Law and everything you do is going to be backwards, we cannot predict what the markets are going to do next year. We cannot predict when the bottom of the market is. I mean, the idea is, sure, we want to do conversions when the market is down so that we can convert more shares for the same dollar value, but we can't predict when the bottom of the market's going to be. We only know what we know, and for this time, we know what the tax brackets are. We know what potentially the income is going to be. We cannot tell you when the bottom of the market's going to be in the next year. We cannot tell you when the top of the market's going to be in the next year. I can't even tell you whether it's going to be positive or negative at any time during it's going to be up and down next year, so it's going to be positive and negative at different times. But when? I don't know. So I go back and say, you know what? I'll play the odds. And so let's do it early in the year to make sure we get it done. If we have that much control over your taxable income, let's do it early and pray for the best. Hope that markets go up. Now, if you're wrong, it will make a small difference in the long-term rate of return, but it's not going to make a big difference. If you had converted in 2007 instead of 2009, again, it was a big difference in market value. But when we go 15, 20 years out, and that's what we're doing with Roth conversions for the most part, the difference in return is going to be a couple percent here or there. If you had done it at the beginning of 2018 versus the end of 2018, if you remember back to 2018, the markets took a little bit of a downward spin, shall we say,
yes,
towards the end of 2018, basically finishing up the day before Christmas. It was down about 19% from its high. But if you look and you said, well, shoot, I wish I would have waited until December 24th to do my conversion. But the reality is it wouldn't have helped you that much because, the markets went up for the first part of the year, then down for the second part of the last part of the year. And all in all, it wasn't all that much difference, from where you were.
So are you saying the time of the year really doesn't matter all that much? You're saying that
I haven't seen where the time of the year can matter unless you can predict what the markets are going to do. And I haven't found anybody yet that can predict what the markets are going to do
with certainty. I mean, I could.
Oh yeah, they predict all the time.
I could make a prediction, and I could guess and maybe be right a time or two. Doesn't mean I knew it was going to happen.
Sorry, I'm not going there with that.
I'm not going to do that. So really, the time of year, I guess what you're saying is the time of year doesn't matter all that much. It's more about the strategy of actually doing it, which is what we talked about last week. Should you do a Roth conversion? Should you not? I would suggest if you missed that podcast, you can have a listen to it. You said you were talking to some people about doing this, but their particular situation warranted that maybe they could take it earlier in the year and be okay. Flexibility.
Yeah. Some people don't have the flexibility where all their sources of retirement money is coming from their IRA. And if they have that proverbial emergency and they need more money, they're going to have to get it from an IRA. In that case, let's do it at the end of the year, make sure we don't have the emergency.
Yeah. Now you said they had a lot of a large cash position. In other words, they had a lot of cash that they could live off of.
Yeah.
In this particular case, how does that help? If I have a whole bunch of cash, let's say I could live for a couple of years, pay all of my expenses. I'm retired. I don't have an income. How would that help me in this particular instance?
Well, your choices are a couple things. You either live off the personal money and have no taxes and then deal with the IRA at a later date. You live on the personal income, control your taxes, do Roth conversions so that later on you have no IRAs left when you've got your pensions and Social Security, if that's the case. And that's actually what was happening with this case. Or you live on IRAs up front and invest the personal money for growth, which I don't have a problem with either. But it's all a matter of managing where the taxes are coming from. In this particular case, the individual retiree was 56 years old. They were going to be unemployed by choice. They have a pretty good sized IRA, but they need health insurance. And so they were keeping their income down so they could get the Affordable Care Act subsidies. And so they were playing with those numbers. That's one thing they were looking at. And so there's different reasons why people will keep their income down. So the question is, if you have a large personal asset position and a large IRA position, or a sufficient, I should say, IRA position, should you use your IRA to live off of or your personal money to live off of? If you Google it on the financial websites, tell you never touch your IRA, but that's a mistake. You either use your IRA to live off of using the lower brackets, or you live off personal money and use the lower brackets for doing Roth conversion. The difference there is, which account do you want to grow? Do you want your personal account to grow, or do you want a Roth IRA to grow? I kind of like the Roth IRA, but it does entail paying some taxes. Some people really like not paying any taxes for a while.
Now, when you say a personal account, let's explain what we mean by this. Personal money.
Something that's not sheltered by an IRA. It's not a 401k. It's not an IRA. It's not something that has tax-deferred category associated with it. It's not an annuity. It's not an IRA. It's not a 401k. It's not a retirement plan.
But could it be a brokerage account with mutual funds or stocks?
Something that's in my name and where any investment earnings that are realized are taxable to me in the year that it happens. So if I earn interest, I pay taxes on it in the year it happens, whether I spend the money or not.
So it could also be cash or CDs or any of that stuff, right?
Yeah, if it's in my personal name, or if I have a living trust, if it's in my living trust name.
So you're saying it's not a tax-deferred type thing, like you said, a 401k
an IRA
or something like that.
Not a Roth IRA. So it all has to do with knowing where we're at. Now, not everybody should consider conversion. Some people, they've got their IRAs and their income is such that they're not going to pay much in the way of taxes when the money comes out of the IRA anyway, because their income is relatively moderate. Other people, they've got big IRAs, and we know that their taxes are going to be higher later on because they're going to have their pensions, they're going to have Social Security, maybe they're waiting, and they're going to have fairly large required minimum distributions. So in that case, before we get to the higher pension days, the higher Social Security days, and things of that nature.
Yeah, it's an interesting thing to have, and it's a good position to be in. And if I'm just going to throw out a quick example, let's say somebody's got $1 million. It's a lot of money, I understand. It's just that it's easier to do the math this way. But I have $500,000 of personal money, the type that you just talked about a moment ago. And I have $500,000 of IRA money. I'm retired. I say, look, I've got to take an income. I need a certain amount of money to spend. I need 40 grand or whatever it is to spend out of this $1 million that I have. Where do I take it from? Do I live on? This is the question you asked a moment ago. Do I take it all from my personal account? Do I take it all out of the IRA? Do I go online and try to get advice there? Do I take a half and half?
I would say going online to get advice through the generic pundits out there is disaster, because they say never touch your IRA until you're mandated to touch it. Let's say you're 62 years old and you need that 4% distribution, $40,000. If you take it all from your personal account, so you've got your $500,000 of personal money invested for safety, because you're going to be taking $40,000 a year out of it. So the majority of it's going to be invested for your income needs. That means you're not going to touch your IRA for 10 years. Your $500,000 in your IRA is going to grow, hopefully, over the next 10 years. Maybe it grows at 7, 8, 9%. It could be worth $1 million, $2 million, $3 million, $4 million by the time you have to take a required minimum distribution. So if you're taking your $40,000 out of your IRA, yeah, you could be in a fairly low tax bracket right now. But once you hit that required minimum distribution age, you've got, $40, $50, $60, $80,000 plus your Social Security coming just from the taxable event of an IRA. I would say you would be better off taking a little bit from both. Now, it all depends on what you're doing with your Social Security as well. So this all comes full circle. You got to start with what's my game plan for all of my different incomes? What's my Social Security going to be? When am I going to take my Social Security? Do I take it at 62? Do I take it at age 70? That has to do with my longevity. How much do I actually need? But there are ways, and especially using it in the early years, maybe using the IRA to live instead of taking my Social Security early, and drawing down the portfolio a little bit, and then turning my Social Security on and not having to take as much from the portfolio. And now I don't have much IRA, so now I don't have much required minimum distribution. And I can use the 12% bracket now for the next 6, 7, 8 years, or for as long as we have it.
Or whatever the tax bracket. We don't know what tax brackets will be, of course, 3, 4, 5 years from now. But yes, we'll make that assumption.
But it's still going to be the lower of the bracket,
sure,
whether it's 12% or 15%. And then when I get to retirement, if I've gotten rid of most of my IRA, either by spending it or by converting it, now I've got my Social Security, and I've got a big Social Security at age 70. Maybe I don't owe any taxes for the rest of my life.
But you're suggesting then that I should take money, if I'm in this situation, take money and pay taxes on this? Because money, it comes out of my IRA, I read, is taxable, a traditional
money
IRA.
Money is taxable when you take it out of the IRA.
Gee whiz.
But remember, for a married couple, the first, roughly $25,000, $24,800, and depending on whether you're 65 or not, you don't pay any tax on. The next $40,000 of income, you pay a combination of 10 and 12%, mostly 12%. So I can have about $55,000 of income and stay in that low 12% bracket or less. So my effective bracket is like 8 or 9%. Once I get over that $50,000 mark, $55,000 mark, then I start paying 22%. Not on all of the money, only on the amount over that $55,000. So if we can mix and match and keep even if we need, $60,000, $70,000 a year for retirement, I take some from my cash position, I take some from the IRA, maybe some from my Social Security if I take it early, and I can stay in that lower bracket. But if I don't take it from the Social Security and I spend my personal money down to where I don't have any personal money left, and now I'm getting my Social Security and another $40,000, $50,000 of Social Security between the two of us, I'm getting $80,000 of income, and almost all of it's taxable, and a big chunk of it's going to be in the 22% bracket. So it's all a matter of managing where your income is coming from so that you can be as efficient as realistically possible with your tax brackets.
Managing your financial future and present.
Managing your financial present and your future is where we're looking at helping people out.
It is helpful to know something about tax brackets, but I suppose if you don't know anything about tax brackets, you should talk to somebody who does know something about tax brackets and how taxes work. Because again, this is coming back down to something else that we've talked about before, Professor Plum, and I think you said this was that if you can manage your taxes, you can really take more control, I guess.
Well, if you can manage your taxes and ultimately pay less in taxes, that means either you have more to spend because you're not sending it to Uncle Sam, or your heirs will inherit more. People, if you gave them a choice you have 3 choices. Do you want to spend more money? Do you want to give more to your kids? Or do you want to give more to the government? Which of those issues do you want to accomplish? They would say number 3 is the government. I would expect, even if you're not that thrilled with leaving a lot of money to the kids, you'd rather leave it to the kids than the government, or give it to the government.
I would hope so. I'd hope maybe you'd have some charity you would rather give it to too, rather than have it just go to.
Hey, charity is another thing that you can plan with once you're age 70 and a half. There are things about that you can deal with.
Well, there really are, and the fact that we're out of time for this particular podcast tells me that this is something we should talk about on our next podcast. Charitable giving. I mean, you can give any time of the year. But people start to think about this, I think, as they get toward the end of the year, as we get toward the gift-giving season, depending on when you're listening to this podcast. Maybe we should talk about that next time.
Charitable giving with IRAs and retirement?
Yeah, because if you give to a charity, can anybody deduct it, or are there limits to what can be deducted?
Also depends on how you give it.
Exactly. So why don't we talk about this next time? This is a great segue. And the fact, as I said, the fact that we're out of time means we can't talk about it now. So we are committed. I am not going to forget this. The topic for our next podcast is going to have to do with charitable giving and these things called qualified charitable not distribution.
Qualified charitable distribution.
Thank you. Yes. I was going to give the QCD, and for some reason I forgot. I want to make sure I had the correct the correct title of that. QCDs. So we can talk about that next time. But in the meantime, you know something? If you need some more help from Professor Rick Plum, and many of you know him already, or you've talked to him, or you've worked with him. But if you need some extra help and talk about things like taxes and planning and really just setting yourself up potentially for next year, should you do a Roth conversion? Does it make sense to do a Roth conversion, as we talked about today and last week? It's always a good idea to have somebody take a look at the numbers and look at your individual situation. You can get in touch with Professor Plum or any of the Lucia Capital Group advisors, 800-644-1150, the off-air number, 800-644-1150. They've been a longtime sponsor of this particular podcast, and we thank them for that. And it's a good idea to at least have somebody take a look at the numbers for you, because whether you know taxes or you don't know taxes, it's nice to have an outside person take a look at it for you and make some rational decisions, I think. Potentially, hopefully that's the case with you. 800-644-1150, or go online. Another good way to do that, luciacap.com, luciacap.com. So, Professor, you've got next week's topic all set?
It sounds like we do, yes.
All right. Just want to make sure. Don't let me forget. All right. I'm going to hold you to this. But if I get halfway through...
We'll see which one of us remembers, if either.
Between the two of us, we're like 115 years old or something. I don't know what we are, but one of us should remember. LuciaCap.com. For Professor Rick Plum, I appreciate you all listening. For Professor Plum, Certified Financial Planner Professional, I'm your host, moderator, Johnny Dean. Thanks so much for listening, managing your financial future, and we'll talk to you again next time.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by LCG, will either be suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. CDs are FDIC insured up to $250,000 $100,000 per depositor per insured bank for each account ownership category. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.